Construct and interrogate asset and corporate backed models. Understanding the three statement model. Presentation overview. Introduction to three statement model. The three statement model is an essential tool for financial modeling, which provides a framework for assessing the health of a company. It consists of the income statement, balance sheet, and cash flow statement. Setback models and corporate backed models. Setback models and corporate backed models are two types of financial models that use the three statement model as a basis for their construction. Setback models use the cash flows from specific assets to determine their value, while corporate backed models use the cash flows from a company's overall operations. Interrogating and drawing meaningful insights. Interrogating financial models is an essential aspect of financial modeling. It involves analyzing the inputs and assumptions used in the model and determining their accuracy and relevance. Drawing meaningful insights from these models requires a deep understanding of the underlying financial data and the ability to interpret and extrapolate trends and patterns. Introduction to three statement models. The three statement model is a financial modeling framework that is used to forecast the income statement, balance sheet, and cash flow statement of a company. It is a powerful tool for financial analysis and decision making. Constructing asset-backed models using three-statement model. Asset-backed models. Asset-backed models are used to value assets that generate cash flows. These models provide a way to assess the worth of assets that produce a consistent future income stream. Three-statement model. A three-statement model is a financial statement analysis that includes the balance sheet, income statement, and cash flow statement. This model is used to create asset-backed models to value assets that generate cash flows. Discount rates. Selecting the appropriate discount rate is an important step in constructing asset-backed models. The discount rate is the rate at which future cash flows are discounted to the present value. Net present value, NPV. Net present value is the value of an investment in today's dollars. In asset-backed models, net present value is calculated by discounting future cash flows to their present value using the selected discount rate. Cash flow projection. The first step in constructing an asset-backed model is to project the cash flows generated by the underlying asset. We'll discuss the process of cash flow projection and how to incorporate different scenarios. Discount rate calculation. There are different types of discount rates used in financial modeling, including WACC, CAPM, and Fama-French. We'll explain the differences between these and how to select the appropriate one for the asset. Net present value calculation, NPV. The net present value is a financial metric used to evaluate the profitability of an investment by comparing the present value of its expected cash flows with the initial cost of investment. It is an important concept in financial modeling and helps to determine whether an investment is profitable or not. Constructing corporate-backed models using three-statement model. Corporate-backed models. Corporate-backed models are used to value companies and their equity. They are constructed using financial statements and other financial information. Three-statement model. The three-statement model is used to construct corporate-backed models. It includes the income statement, balance sheet, and cash flow statement. Discount rates. The selection of appropriate discount rates is an essential part of constructing corporate-backed models. Discount rates are used to calculate the present value of future cash flows. Enterprise value. Enterprise value is a measure of a company's total value. It is calculated by adding the market value of equity, debt, and preferred stock and subtracting cash and cash equivalents. Calculating enterprise value. Enterprise value components. Enterprise value is composed of market capitalization, debt, cash and cash equivalents, and minority interest. Understanding how each of these components work together to form enterprise value is essential to constructing a corporate-backed model. Calculating enterprise value. Enterprise value is calculated by adding market capitalization, debt, and minority interest, and subtracting cash and cash equivalents. This formula is used to determine the total value of a company's operations and assets. Calculating equity value, adjusting for debts and other liabilities. When calculating equity value, it is important to adjust for debts and other liabilities. This is done by subtracting the total amount of debt and other liabilities from the total assets of the company. Calculating equity value. Equity value can be calculated using the three-statement model. This involves analyzing the company's income statement, balance sheet, and cash flow statement to determine its overall financial health and stability. Discount rate selection. The discount rate is an important factor in determining the equity value of a company. We'll discuss the different types of discount rates used in financial modeling and how to select the appropriate one for the company. Interrogating models. Interrogating asset-backed models. Interrogating asset-backed models involves analyzing the underlying assets and evaluating the model parameters to assess the risks and returns associated with the underlying assets. Interrogating corporate-backed models. Interrogating corporate-backed models involves analyzing the financial statements and market data of the company and evaluating the model inputs to assess the risks and returns associated with the company's operations. Sensitivity analysis. Sensitivity analysis is a method of testing the accuracy and reliability of financial models by examining how changes in assumptions or inputs impact their outputs. It is commonly used in asset-backed and corporate-backed models to assess their overall risk and returns under different scenarios. Scenario analysis, asset-backed model. Scenario analysis is an important tool for asset-backed models as it allows investors to evaluate the potential risks and rewards associated with investing in a specific asset class or portfolio of assets. Corporate-backed models. Corporate-backed models rely on scenario analysis to evaluate the financial health and stability of a company under different economic and market conditions. It helps in assessing the company's ability to pay debt and dividends in different scenarios. Conclusion. Three-statement model. The three-statement model is a popular financial modeling technique used to analyze and forecast a company's financial performance by examining its income statement, balance sheet, and cash flow statement. Asset-backed model. An asset-backed model is a type of financial model that uses a company's assets as collateral to secure financing. It is commonly used in industries such as real estate, automotive, and consumer finance. Corporate-backed model. A corporate-backed model is a type of financial model that uses a company's creditworthiness to secure financing. It is commonly used in industries such as telecommunications, energy, and utilities. Interrogating the models. Interrogating the models involves analyzing and interpreting the model's inputs and outputs to gain insight into the company's financial performance, strengths, and weaknesses. Thank you.